Okay, so I want to say welcome to everyone and thank you for joining us today in our third program of our 2020 summer series sponsored by the Women's Leadership Initiative at Albany Law School. This program today is Financial Statements 101, representing business clients with Jennifer Bohl, a member of the law firm of Bond, Shenick and King. We will be recording this program so that we can send it out to anyone who may miss it today. Please make sure that you are muted for the program, and if you have questions, feel free to post them in the chat, and I'll make sure that Jennifer is able to see them and answer them throughout the program. So without further ado, I'd like to introduce to you Jennifer Bohl, who will be presenting today. Jennifer advises privately held companies and individuals with respect to a wide range of corporate and tax matters, including mergers and acquisitions, real estate, financial transactions, and complex trust and estate matters. In addition to her legal practice, Jennifer is a lecturer for the MS in Taxation program at the University at Albany, where she teaches courses on federal, state, and interstate taxation. She is also an adjunct professor at Albany Law School, where she teaches courses on corporate tax, partnership tax, state and local tax, and estate planning. Jennifer is also a member of Bond, Shenick and King's Management Committee. Thank you so much, Jennifer, for being here today.
Thank you. Well, thanks for having me. I'm really excited that there are so many wonderful people who are interested in financial statements. So I had no idea that we could get, dozens of people to actually log on at lunchtime to learn about this. So thank you, Mary, for giving me the chance to talk about it. We were trying to figure out all the technical issues when we started, so I'm hoping I can run through the PowerPoint easily. So that is about me. This is all of the stuff that Mary already said. So let's start with trying to figure out why would you want to know about financial statements? Why is that important, especially for lawyers, or I know we've got a number of law students as well who signed on today. So, what do we use financial statements for? We use them really from an internal and an external perspective. So if you're a business, every business of any size needs to have financial statements. We would use them ourselves to figure out, well, how are we doing? Are we profitable? What do we have? We might even have financial statements as an individual. So if you've ever applied for a mortgage or even maybe a car loan, they've asked you about what your income is and what your expenses are. Well, that's a very simple form of a financial statement, and we'll talk about the main financial statements that businesses have in a minute. So lawyers are important users of financial statements, every lawyer, whether you're representing businesses or not. And a few areas of law, obviously, where you might need to really understand the ins and outs of a financial statement would be in the mergers and acquisition field. So not only will you see the financial statements as part of the transaction, but you'll have to include provisions in your contracts relating to them. So it's really important to know, what they say and what they mean. But do lawyers actually prepare financial statements? And the answer to that is generally no. So we usually are working with other professionals who are preparing the financial statements, and lawyers are really users of those financial statements. So lawyers need to be able to understand what they say, but you don't necessarily need to understand how to create the financial statements from the books and records of a business. And that's what we're going to focus on today, really understanding what the different statements are and why you might need to use them. So, and the last statement is for lawyers. One of the other reasons you need to understand financial statements is if you have your own law firm, obviously you also want to know how is your own business doing. So that's really important. So how do they inform internally for a business? Well, they let a business know, whether they're making a profit, what their equity looks like, and how they need to plan for the future. they inform externally a lot of different important people. So investors are one group that we use financial statements to inform. So investors want to know, how is the business doing? Banks, lenders, creditors, including lawyers who might be plaintiffs' lawyers. So if you might think, well, I want to be a litigator, I probably don't need to know much about financial statements. Well, you need to probably know even more about financial statements, because you may become a creditor of, or your client will become a creditor of a business, and you might want to know, how are they doing? Are they likely to be able to pay a judgment, for example? Or you may be looking to settle, and they may say, well, we can't afford to settle, and you'll want to be able to really scrutinize that and review those financial statements. Another area where financial statements particularly leak into a lawyer's practice is with government. So government regulators often require financial statements for various registrations. An easy example would be if you're a franchisee or a franchisor, you need to file your financial statements with government authorities in many cases. And of course, if your stock is publicly traded, your financial statements would also be required to not only be filed with the SEC, but also posted publicly. So that's a great resource, and we're going to use that later on to take a look at some financial statements. So when we're informing particularly when we're looking externally at the external users of financial statements, we really want to be able to compare businesses. So that's really important, think about investors particularly. So one of the things that the financial statements are prepared on a consistent framework. So once you know how the financial statements were prepared, then you can compare one business to another. But one thing to always remember is financial statements are always backward looking. So they're never forward looking. Those would be projections, but those aren't financial statements. So we're always looking at a business as it was before the date that we're reviewing those financial statements. So that's an important concept to make sure you understand. Okay, so in terms of that consistent framework, how are the financial statements being prepared? There are two main methods of preparing financial statements: the cash method and the accrual method. So the cash method is usually what an individual would think of if you wanted to know, how am I doing? Or you're filling out that car loan application or mortgage application. So if you're using the cash method of accounting, you record cash when you receive it, and you record an expense when you pay it. And so often that might really be, some businesses sort of, if they don't have sophisticated financial statements, will run on the cash method. And it's often pretty consistent with your bank account. So whatever's in your bank account is oftentimes the profit from a cash method of accounting. But where we see most more sophisticated businesses, they usually rely on the accrual method, and that's a little bit more complicated. So when you're using the accrual method, you're recording your revenue when you earn it, and you're recording your expenses when you incur them. So this is used for more sophisticated businesses because we're better matching the income you receive to the expense period that you've incurred the expense. And I'll give you a little example, I think, from legal practice, because that'll be easy for us to understand. So let's assume that you are one of those litigators and you're performing services on a really big case. So you've got a number of different lawyers working on this case, and you're paying your associates who are doing all kinds of sophisticated research, writing motions, and you've earned a fee and sent a bill out for $1 million on this case. But the client's not going to pay you unless and until the case is completed. So you've agreed not to get paid until the case is completed. So with the accrual basis, when you send out that bill for $1 million, you are going to record that revenue because you've earned it. You haven't been paid yet, but you've earned $1 million. And that matches very well with the associate salaries you've paid over that year or 2 years, however long you've been working on that case. you'll be able to match that with the period in which you actually earned the fee, even though you haven't been paid yet. Now, if you're on the cash method of accounting, you won't record that revenue until the day the check comes in. So until that client actually pays you, you haven't made $1 million. You will record the expenses as you pay them. Remember, that's how cash works. Expenses when paid, cash when received, not when incurred. So you're going to record as an expense all those associate salaries. Maybe that's your only case you're working on. So for a whole year, you pay your associates hundreds of thousands of dollars. And it looks like you're doing really poorly because you don't have any revenue to match that. So that doesn't really give us a good sense of how your firm is doing. We would want to record the revenue as it's earned and the expenses as incurred. So accrual is typically what you'll see, but it's important to understand that that isn't necessarily indicative of how much cash a business may be generating. And so how do we determine when we record revenue, for example, when we record expenses in the financial statements? We use GAAP, and GAAP is the generally accepted accounting principles, and those are promulgated by the Financial Accounting Standards Board. So it's really a set of rules like statutes, like we're used to with laws. So these are sort of the laws associated with financial statements. So that really is the Bible for CPAs, who are the folks who are most commonly preparing the financial statements. They will look to GAAP to figure out what needs to be reflected on there. So that's an important concept to understand and something to check on whether financial statements are being prepared in accordance with GAAP, because that will tell you whether it's good to use those financial statements to compare to another business. And most larger businesses will prepare their financial statements in accordance with GAAP. So we've talked a lot about them. What are they? The three main financial statements that you'll see, and I'm sure you've heard of these before, even if you haven't been that interested in financial statements previously to today, is the balance sheet, the income statement, and the statement of cash flows. So the balance sheet is the most simple of financial statements, and it's one that you may have prepared yourself, again, if you're working on an application for a mortgage, for example. So the balance sheet is as of a certain date. So you can prepare a balance sheet today, July 16th. What does your balance sheet look like? That's all it's going to tell you is what is your financial condition today. And we'll talk more about what's actually shown on the balance sheet in a minute. We'll look at all three. The income statement is not as of a certain date. So the balance sheet always has one date. That's the date that we're looking at a business. It's a snapshot. The income statement is during some period of time. So we look at the income created by a business, and I'll explain what's on that income statement in a few minutes, but it's always over a period of time. So it's from July 16th, 2019 to July 16th, 2020. You could do an income statement for a month, July 1st to July 31st. So it can be any period of time, but it's always during some period of time. What was the income? And then the statement of cash flows is really the most complicated, in my mind, financial statement, because it's a hybrid. It brings in concepts from the balance sheet, the as of date, which is what cash did you start with? And then it tells you what cash came in and what cash went out and what cash you've ended up with. And so it also has concepts of during the income statement. So it pulls pieces from both of those other two statements. The reason why, though, the statement of cash flows is crucially important is because when you're using the accrual method of accounting, which is what we'll focus on because that's what most larger businesses focus on, we do need to know, that, well, I'll go back to the lawyer with the case where you've incurred $1 million fee. Where's the money coming from to pay those associate salaries all this time? So on the accrual basis, you've sent out a lot of bills, but do you have the money in the bank account to actually pay all those salaries and pay your rent and all of that? So the statement of cash flows will tell you that. And oftentimes the answer to that is borrowing, but you would need to know. It's important when you're assessing a business, you want to know, do they have the cash, not just are they showing a profit? So, again, I put the question mark lawyers, and the reason why I wanted to raise that again is, what is the lawyer's role in these three types of financial statements? And generally, we're not preparing them. We're going to work with CPAs who will prepare those financial statements, but we need to understand what's on them, how to read them, what they tell you, and maybe even more importantly than what they tell you, we need to understand what they don't tell you. So, and I think the balance sheet is a great first example of that. So the balance sheet always balances, first of all. So we always have assets on the left, liabilities and equity on the right. We'll look at a sample balance sheet at the end, and oftentimes those are shown with the assets on the top and then liabilities and equity below. But an old-fashioned balance sheet literally balances left and right. So the assets are all of the things that the business owns. So it would be current assets, which are things like cash, could be things like accounts receivable, so those bills that you send out. They're always recorded at book value. So what is book value? Well, let's compare that to market value. Those are terms that maybe you've heard before, particularly book value. So book value really is, what's your historic cost less any accumulated depreciation. So I like to use a car as an example of book value, and a business would have oftentimes many vehicles. So if you've got vehicles on your balance sheet and you paid $50,000 for the truck, for example, that would be the historic cost, what you paid for the vehicle, $50,000. Depreciation is a financial record of how that asset's value is declining over time. So the value declines over time. And if you've ever bought a car, you probably were very disappointed if you looked up the fair market value of the car about a year after you bought it, because cars actually tend to really decline in value quickly, the first couple of years you own them. So depreciation doesn't really work like that. It's usually a fixed amount each year, depending on the type of asset. But it's the idea of it is to reflect how the value is being reduced. So it's not necessarily what the market value is. So you may have a building. Buildings also depreciate in value, but the market value of that building may not have actually gone down. From the perspective of the balance sheet, that doesn't matter. So the balance sheet is always your book values, your historic cost, less accumulated depreciation, with just a few exceptions. So there's some areas where we do see a market value, and usually it's where market value is easy to assess. Two things that I think are important that don't show up on the balance sheet. So you've got a business, you look at what are all their assets, pretty easy to figure out the historic cost, less accumulated depreciation. A balance sheet isn't really a difficult thing generally to draw up. And then as you acquire new assets or dispose of assets, the balance sheet would be updated as of whatever date your balance sheet is being created for. So let's think about your personal balance sheet. So you might have a car, might have a house, bank account, some stocks. So you'd have all different types of assets, and that would be what's on the left side of the balance sheet, all those things. But what about your ability to earn an income? And when I talk about balance sheets with law students, I talk about your law degree. And, most of them, their parents said, your law degree is really valuable. An education is so valuable, and it is, but it doesn't show up on the balance sheet. So if someone's looking at your personal balance sheet and trying to assess what your net worth is, and that's where the equity piece is on the right-hand side, after all your liabilities, because when you're a law student, one of your biggest liabilities is probably your law student loans. So your balance sheet may show that you don't even have a positive net worth, but you're really valuable. How do you know that? Because you have this education, but that doesn't show up on your balance sheet. Businesses have something like that too. It doesn't show up on their balance sheet. And you might wonder, why is this business being maybe sold for a high value? When you look at their balance sheet, it looks like they have almost no equity. They have lots of liabilities and assets that aren't worth very much. Well, they have an asset that doesn't show up there either, similar to your education, and it's their own self-created goodwill. So if you're a business and you've created goodwill in the community, i.e. the ability to earn income, customers are going to come to you. That's really what goodwill is. That's not going to show up on your balance sheet. So that is an asset. It's really valuable. Third parties will pay for it, but it's not there on the balance sheet if you've created it yourself. You do see sometimes goodwill on balance sheets of businesses, and that's because they would have purchased goodwill from someone else. So that will show up on the balance sheet if it's purchased. But if it isn't purchased, if it's created internally, that doesn't show up on the balance sheet. So that's one of those areas where it's important to understand what the balance sheet tells you, but also what it doesn't tell you. So we've got our assets, and then we have our liabilities. So liabilities are all of the debts of the business generally. So what are the current liabilities and then non-current liabilities, including things like long-term loans, lines of credit, that sort of thing. And then your equity is the idea of your net worth. So assets minus liabilities equal equity. And then we balance it because the assets equal the liabilities plus the equity. So that's your net worth. All right, so let's talk next then. So that's our balance sheet, our snapshot. What do we have? Then, so that's important for a business. What do we have? But we also want to know, what do you make? So what do you have versus what do you make? So the income statement is going to tell you, what do you make? And the simple statement of the income statement is revenue less expenses equals your net profit or your net loss. And remember, the income statement is during some period of time. So it could be during a month, it could be during a quarter, a year. You could have an income statement. Typically, we don't go longer than a year, but you certainly could. There's no reason why you couldn't. So remember, the first thing you want to look at when you're reviewing an income statement is trying to figure out, is it prepared on a cash basis or an accrual basis? And if it's a larger business, it's generally prepared on the accrual basis. But you would want to know that, because if it's a cash basis, then the revenue and expenses are recorded only when received or paid, respectively. And if it's an accrual basis, it's when earned. And with expenses on the accrual basis, we record those when they're incurred, not necessarily when they're paid. So that's important. It goes right along with the idea of the revenue. So when we're looking at revenue, we often will separate our operating revenue, and then we'll subtract certain kinds of expenses first. So an operating business will generally subtract their cost of goods sold first, particularly if it's a manufacturer. They would want to know then, what's our gross profit? So we have our operating revenue, our cost of goods sold, what's our gross profit? And then you would subtract your selling, general, and administrative expenses. So those are all the kind of periphery expenses that you need to incur. And that will give us what our operating profits are. And that's really important, especially for an investor trying to assess a business. They want to know what the operating profits are for the business. And then we'll also differentiate between cash and non-cash expenses. And one of the things that you'll hear a lot about, and it comes from the income statement, and maybe you have already, especially if you're in the M&A area, is EBITDA. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And it's a metric that a lot of financial folks will use to assess a business. And sometimes it's also used in valuation. So you can determine EBITDA by looking at the income statement. And the reason we take our net profit or our earnings, and then we add back certain expenses. So that's why they say earnings before. It's really just an add back. So you look at your net profit and you add back interest, taxes, depreciation, and amortization. And it is a rough estimate of the cash flow of a business. And so that's why financial folks want to know what the EBITDA is of a business. What's the cash? Because remember that depreciation and amortization. So depreciation is for tangible assets, things like your cars that we talked about. Amortization is the same concept as depreciation. The value is decreasing, but it's for intangible assets. So things like intellectual property, or if you paid for a non-compete agreement, for example, you might amortize that over time. The expense is recorded over time, but it's not really cash going out the door. And interest is really a reflection of how much debt you have, and taxes similarly relies on the income. So we've got our, yes.
I'm sorry to interrupt, but I think this is actually a good place for this question we received. Does goodwill get depreciated like other assets?
Good question. It doesn't. So usually under GAAP, goodwill could have a charge to it, and it would be charged or reduced if it's impaired in some way. So GAAP usually would require that a CPA who's preparing the financial statements review the goodwill as recorded on the balance sheet and make a determination if it's been impaired in some way, i.e. it wouldn't be as valuable anymore. And then sometimes you will see it being reduced because of that impairment. But it isn't generally depreciated over time for financial statements. Now that's different in tax. Goodwill is amortized. So there are a lot of areas where if you're familiar with tax, the rules for financial statements are sometimes different, and goodwill is a good example of that. Mary, I just wanted to let you know I can't see when there is a question, so please just interrupt me. It doesn't seem to be showing up anywhere. I'm kind of looking at all my screens.
I will monitor it.
Okay, thank you. Okay, so that could be a charge or an expense. And then we come down to our net profit or net loss for whatever particular period we're looking at. So the income statement is really just telling us how did we do for that particular period. So next, let's talk about the statement of cash flows. So remember I said when we introduced this financial statement that it's really a hybrid. So it's a hybrid because the things that show up on a statement of cash flows come from both the balance sheet and from the income statement. So when we're looking at, well, what does the statement of cash flows tell us? Well, what you can find there that's very important is you find what was your beginning cash. So how much cash did you have at the beginning of a period? So the statement of cash flows does run over a period. It's during a period. Where did you start and where did you end with cash? So you see that the top of the page, the beginning of the cash, bottom of the page is ending cash at the end of whatever period. So you might do that annually or quarterly. And then you need to know, well, what are your sources of cash? So there are three main buckets where cash comes from for a business. It comes from operations, it comes from financing, and it comes from investing. Cash from operations is exactly what it sounds like. That's usually cash that comes from your operating profits that we might have determined in our income statement, but we wouldn't include any non-cash expenses there. So you have to make adjustments. So if you had depreciation, for example, that's not a cash expense, or a charge for goodwill, that's not a cash expense. So we just want to know what cash we're actually generating from operations, and that could be more or less than our net profit. And then cash from investing, or used by investing. So those three categories, operations, investing, and financing, also apply to uses of cash. So we may use cash in operations as well for things like paying expenses, operating expenses. Cash from investing, so we may generate cash from our operations, but buy some fixed assets with those. And so that would be a use of cash in investing. So, and I'll give you a comprehensive example once we go over it, and it will hopefully make some sense. And then we may have cash from financing. So that's often we will receive cash because we borrowed money. So let's go back to the lawyer example. I love the lawyer example with the wonderful case where we've earned $1 million fee. And so that's, you know, especially for you young lawyers, someday, right, you're going to earn that $1 million fee. But as we said, on an accrual basis, we look great. We've got $1 million fee. We've spent, you know, $400,000 on salaries. So we have a $600,000 profit. We look at our income statement and we feel really good, and we run around the office and are very excited about this income. However, now you realize you've prepared your income statement on the accrual basis, and your associates are knocking down the door wondering when are they going to get paid because you haven't paid them yet. So your cash from operations, when we look at your statement of cash flows, is going to be zero. If that were your only case and you haven't gotten paid yet, you have zero cash from operations. But you may still be able to stay afloat because maybe you're going to borrow. Maybe you have a line of credit. And many law firms actually operate, particularly at the beginning of a year, borrowing on a line of credit. So you may borrow in order to keep paying those associates. So you do actually have some cash. There's money in your bank account. Where did it come from? Well, it didn't come from operations. It came from borrowing. So you may have some cash from financing. And that's, it could be long-term debt, it could be short-term debt, but that may be how you're going to support your operations. And that's okay as long as, you know, hopefully that $1 million case will eventually pay. But if somebody is looking at your law firm, or you're looking at it and trying to assess how am I doing, the income statement looks great. You have a $600,000 profit. You feel really good. Your balance sheet is going to look okay. So you've got some cash, and you've got a lot of accounts receivable because you're owed all this money. But your statement of cash flows is really where you're going to be able to find the full story. And so with any kind of business, the statement of cash flows is really one of the most important things to look at, because even a business that looks profitable, if you run out of cash, what's going to happen if you can't pay your associates and you're not able to secure a loan to get cash? Well, they'll probably quit eventually if you can't pay them, or you'll have to lay them off if you don't have the cash to pay them. And then maybe you're going to lose the case, or you won't be able to continue your operations. So making sure you have sufficient cash to support your operations is really, really important. So the statement of cash flows is going to tell you a lot. And we'll look at a statement of cash flows in a few minutes. So when we're looking at these financial statements, we've got our 3 financial statements. They're going to be prepared generally by a CPA. Even a medium-sized law firm is generally going to have a CPA preparing their financial statements. So there's 3 kinds of financial statement reviews for a CPA, and I put them in the order of complexity and also the order of cost. So a CPA will charge the most for audited financial statements and the least for compilation financial statements. And that's because there's a huge difference in the work that a CPA is going to do in order to create financial statements using these different levels of review. So compilation statements, all a CPA is going to do if they're preparing compilation statements for a business is put together the company provided information. So they may make some journal entries and make sure everything balances, but that's really it. They're not providing any assurance that the financial statements were prepared using any particular rules. And so usually they probably will not be in accordance with GAAP. So compilation financial statements often have, you know, unusual ways of perhaps recording revenue or expenses. So these are not the best if you're a user of financial statements and you want to compare businesses. Looking at compilation statements isn't great. So I told you at the beginning, banks often use financial statements. So maybe you're going to get into banking law or something like that. And banks will require a business as a creditor, they'll require a business to provide financial statements to the bank on a regular basis. They will also usually specify what kind of financial statements. And compilation is typically, for any business of any size, not going to be acceptable. So a bank is going to want to see a higher level of review from a CPA. So what you would typically see is either reviewed statements or audited financial statements. So review level financial statements, the CPA will give a limited assurance that there aren't any material modifications necessary to the financial statements. So they're not going to give you a full assurance like an audit will give, but they give you some assurance that there isn't anything materially wrong with these statements. The audited financial statements, any large business is going to be preparing audited financial statements. With this, a CPA attests, so they promise, that the financial statements fairly present the financial condition of the company in accordance with GAAP, in accordance with generally accepted accounting principles. So they're making sure that the revenue is recorded when it should be recorded, and the expenses are recorded when that should be recorded, that the balance sheet is showing all of the proper assets. If an impairment of goodwill was required, they're attesting that they did that, that they did what they needed to. They also, in an audit, will check on the company. So a CPA who's preparing audited financial statements will actually check that the inventory is correct, and they'll send out letters to customers and say, you know, we've recorded that you owe $10,000, or your $1 million client if it's your law firm that's getting audited financial statements. They'll say, can you confirm that you actually owe this amount? So they don't send it to every customer, but they do some testing. So audited financial statements, actually the audit is prepared in accordance with generally accepted auditing standards. So there are clear requirements for how a CPA must go about auditing them, and it's really checking them and then attesting that they fairly present the financial condition of the company. And so if you look at any audited financial statements that are provided for public companies, you'll find that attestation there. So the main a great source of audited financial statements, and you'll find the balance sheet, income statement, and statement of cash flow, although sometimes they'll have different names. So some companies will call the balance sheet a statement of position, or they'll call an income statement a statement of operations. But those are all the same things, just different names that you'll find, and each company may have their own name. But you can find every public company is required to file what's called a Form 10K every year, and that will have their audited financial statements included. And so I'm going to, touch the limits of my technological capabilities here and try to pull up the Target, which is my favorite by far, public company or any company. I am in love with their drive up service at the moment. So I'm going to try to pull up their 10K, and I put this link in here. So let's see if it works, and we'll look at their. Okay, does everyone see the 2019 annual report of Target? Wow. All right, I'm impressed with myself right now. So, okay. So where this is, I even did a link into the 10K at the first page of the financial statements, but I'm going to just move up a bit because I think it'll be helpful that you can see the attestation here. So here is the opinion of the registered public accounting firm, which I think is Ernst & Young here. Yeah, Ernst & Young. And they give their opinion or their attestation because these are audited financial statements. And so you'll see right here, it says, We have audited the accompanying consolidated statements of financial position. That's just all the financial statements. And they say, in our opinion, and that's important, the consolidated financial statements present fairly in all material respects the financial position in conformity with U.S. generally accepting accounting principles. And so you'll find any public company will have an audit report, and it will generally say that everything is presented in conformity with GAAP. If it isn't, they will specifically provide that reservation, and that's a very unusual thing. Sometimes they'll include what's called a going concern, especially now with COVID and some companies under financial distress. They will provide a going concern where they say that it's possible the company won't continue in business. So that's one thing you might find on an audit report. So we're just going to scroll down here. So this is the consolidated statement of operations. That's the income statement. So it's just another name for the income statement. And if you're ever wondering what it is, just look at the first thing. And here, the first thing is sales. That's revenue. So they have sales, and then they have other revenue. So this would be sort of non-operating types of revenue. So the Target had $77 billion in sales in 2019. And generally with a public company, their audited financial statements, they're going to show you a couple of years and you can compare them. And that's really helpful. So you can see Target sales have been growing every year, 71 billion in 2017 to 77 billion in 2019. And then their cost of sales. So that's, what did it cost them to buy all the goods that they are selling, basically. And again, that went up, but of course that makes sense because they're selling more. And then their selling, general, and administrative expenses, that also went up a little bit. So that's all that other stuff that it costs them to sell, including, probably paying their people. Depreciation and amortization, that's things like if they own buildings or other kinds of equipment, that's going to have an expense associated with the deemed sort of loss of value. That's going to be recorded every year on their income statement, and then you'll see that again, usually reflected on the balance sheet. So that's going to tell us, well, what's our operating income? So 4.6 billion, and that's been going up as well. It was 4.2 billion in 2017. And then we've got that interest expense. So that would be something you would add back for EBITDA purposes if you wanted to calculate that for any reason. And then we've got other types of expenses. And this is their earnings before income taxes. And then this is what they believe the income taxes would be, a provision for income taxes. So then after taxes, their net earnings from their operations are 3.2 billion in 2019. They were only 2.9 billion in 2017. So Target's doing pretty well. I think I'm buying enough there. One of the few retailers that it was doing well in 2019. I think it's still doing well now. And then they give you some information, because this is a public company, about earnings on their stock. But if you're looking at a private company, generally the income statement would end at the net earnings or loss portion. So now let's take a look at the balance sheet. So here, Target calls their balance sheet the statement of financial position, but it's the balance sheet. And we know that because the top of it is assets. So every balance sheet is organized with current assets first. So these are things that could be liquidated most quickly. And then longer term assets or fixed assets are usually second. There's really no reason it has to be organized that way, but it's just typically how you'll see it. So cash is almost always the first asset on a balance sheet. So they have 2.5 billion in cash. Now remember, this is the period of ending February 1st, 2020. So it's the annual period ending February 1st, 2020, and this is ending February 2nd, 2019. And these are 1 year periods. So they had cash at the end at that period, at that date, February 1st, 2020 of 2.5 million. And on February 2nd, 2019, they had 1.5 billion, excuse me, not billion, not million, billion. They had inventory of 8.9 and other current assets of 1.3. So their total current assets, these are things that could be turned into cash, they're not already cash, fairly quickly, of 12 billion. And then they've got other assets, land, buildings, fixtures. Then here's that concept of accumulated depreciation. So remember, these are all recorded at book value. And then we subtract the accumulated depreciation, and that gives us our net property and equipment. This may or may not relate at all to what you could sell these properties for. So I have a client that owns their office building, and it's in Long Island, and they've owned it for, I don't know, 80 years. It's recorded on the balance sheet for almost nothing, but it's super, super valuable. It's, you know, of really significant value. So you never really know when you're looking at the balance sheet how much everything is actually worth in terms of the assets. So it's just telling you the historic cost less the accumulated depreciation. Really, a balance sheet is most useful to look at these current assets, because those are more, these are the actual, generally the actual value. The inventory doesn't usually change much, in the cash. So then that's the left side, right? And then the right side is the liabilities. And here they call it shareholder investment, but this is the equity or the net worth, the shareholder investment piece. So the liability section always starts with current liabilities. So current liabilities generally means things that need to be paid within a year. So they have accounts payable. So those are just their general bills, right? 9.9 billion. Accrued and other current liabilities, 4.4 billion. And then they have 161 million. That's the current portion of long-term debt and other borrowings. So that's the payments that they have to make within the next year. So their total current liabilities are 14 billion. So I always like to just take a quick look and see, okay, so that's what they have to generally pay within a year. What are their current assets? Their current assets are only 12.9 billion. So if they had to pay everything today and liquidate their current assets, they couldn't. But that's okay. That's actually a sign usually of a pretty healthy retail company. Other industries, that might not be okay. So you really have to compare financial statements to others in the industry, because they're turning over this inventory a lot and generally creating a lot of income. Remember, how much income did they have? We said, just gonna look here quickly, 3.2 billion in net earnings. So after all of those expenses are paid each period, they've got a significant earnings. So their accounts payable, accrued and other liabilities, and current portion of long-term debt totals 14 billion. Then they have long-term debt. So that's actually gone up a little bit. Their long-term debt has gone up. That's 11 billion now. It was 10. So we'll see, actually, we should see that in the cash flow statements. So we should see maybe some cash coming in. And then we've got other long-term liabilities here. And we come to our total equity is 11.8 billion. So we have a total of 42 billion in liabilities and equity. And that balances to our total assets. So total assets are 42,779, 42 billion. Our liabilities plus our equity is 42,779. So that is the CPA's job, to make sure that the balance sheet balances.
So Jen, I have two questions in the chat. Is this an okay time to?
Sure.
Okay.
Yes, because I'm going to move on to cash flow statement, and that's going to just be confusing as heck. So.
All right. So the first question is, how is it that the fair market value of the asset, such as a building, is not determined and reflected in the statement?
That is a great question. I'm so glad that someone asked that. So if we wanted to have the most precise reflection of a business's value or net worth as of a certain date, we would do that. We would have everything appraised every year or every time we create a balance sheet. But that would make it really expensive and difficult to create a balance sheet. And there are a lot of differences in how fair market value is determined. And so because we're using these financial statements as a comparison, using historic costs less accumulated depreciation is generally a good way to kind of compare apples to apples, but that's a huge downfall. It's really a cost benefit though, because it's not easy to figure out the fair market value of assets like that. And so we want companies to prepare their financial statements on a regular basis. But certainly it would be great if GAAP said every 5 years you have to update the value or something like that, but we don't have that kind of rule currently.
Thank you for that. And then the second question is from Professor Rayhan. So in the 2001 collapse of Enron, in the savings and loan crisis, and in the 2008 economic collapse, it was determined that much of the havoc was caused not only by falsified and glorified financial statements, but also by a failure of the auditing firms, including nearly all of the big ones, to do their auditing job properly. If you have a chance, it would be interesting to hear your view on the capture of auditing firms by large economic concerns. It seems particularly important with the likely ugly financial statements that may result for many companies in the COVID era.
Yeah, oh, that's a great question. So there are really only a few auditing firms that would audit the financial statements of a company as large as Target, Ernst & Young being one. And so these audits, I think I said, audits are very expensive. It's the most expensive kind of financial statement. And so these auditing firms have sort of an inherent conflict of interest. And we saw that especially with Enron, and Arthur Andersen was their auditing firm that is now defunct. And they did a lot of other work for the company in addition to the audit work, and definitely did not follow generally accepted accounting principles and really looked the other way when it was determined later when fraud occurred. And so after that, we had a number of different legislative efforts at the federal level to try to separate somewhat the accounting firms from the businesses they audit. So we have the Public Company Accounting Board, where these companies must, if you're going to audit public companies, you must register with them. And there are rules now as well about the auditing firms not being allowed to do other kinds of work for the companies they're auditing, and disclosing in great detail if they do any other kind of work. But the real question, I think, is, do they still look the other way? And the answer has got to be yes, because auditing these financial statements create huge revenues for these accounting firms. And as I said, there's only really the big four that do the audits of the largest companies. So one thing, and we've talked about this, I teach business for lawyers at the law school, and we spend a month or two on a lot of these topics. And one thing that we talk about is, ways to address that issue. And something that some students have brought up before, which I think is a very interesting idea, is to have term limits for auditors. And this has been brought up. So if the auditors were only allowed to audit a company for 5 years, and then you have to rotate to a different firm, that might cut down on that, because really the auditors have a duty to the public, not to the company. And that's important because the public is relying on those audited financial statements. So the accounting firms obviously don't want that. We've examined in my class a lot of public company financial statements, and in many of them, the accounting firms have been retained by that company for 50 years, 60 years, 70 years. So there's probably not very much appetite to rock the boat with that engagement. So that's a great question. I don't know if I had a great answer to it, but I think that is definitely something I think we'll see in the next few years as well, as the economy is suffering. That's when we often see financial statements being manipulated in some way. All right, so I'm going to just pull us back down though to the statement of cash flows. I know we only have a few more minutes, but I do want to just spend a couple looking at it. So this statement of cash flows is going to start with our net earnings, and then they're going to adjust those accrual basis earnings to add back any non-cash expenses and come to our operating activities cash to start with. So cash provided by operations is $7 billion. And then I want to look at the financing because we noted that increase in debt. So then we have investing activities. So this means that Target bought long-term assets for $3 billion. So they used some cash. So they got $7 billion in cash from their operations. And then they used cash in buying some property and equipment. And this is a retailer, it looks like they pretty regularly are investing in property and equipment. They sold some property and equipment, so a small amount, but again, it looks like that's something they do typically. They had an acquisition in 2017 and then some other investments. So this says cash required. You might also see cash used in investing activities, almost $3 billion last year. So buying things. So they have operational cash created, they bought some things, and then financing. So they added to their long-term debt, and we saw that in the income statement. They reduced their long-term debt, so they also made payments. So they got some cash because they borrowed money this year. They also made some pay downs of their long-term debt of $2 billion. They paid out dividends to their shareholders. And again, this is something that you wouldn't always see on a private company statement of cash flows, but that's pretty common for a public company, and they've got a pretty consistent history of dividends. They bought back some stock as well, so they used their cash for that. And then they got cash because it looks like some employees exercised some options. And so the cash they used in their investing activities was $3 billion. So about $3 billion in investing and $3 billion in financing. And so then they had a net increase in cash though. So still the cash that they received from their operations exceeded what they used in investing and financing. So they had $1 million increase in cash. So here we have our cash at the beginning of the period was 1.5 billion, and our cash at the end of the period was 2.5 billion. And if we look back at the balance sheet, we can tie that to the balance sheet. Sorry, probably making you guys dizzy here, going through that. We'll look at, here's the cash. So the cash was 2.5 and 1.5, so it ties. Any other questions? We've got about 3 minutes left. So this is a really, I do think the statement of cash flows shows you a lot. If you have a business that's in trouble, they might not have a lot of cash from operations, but they may be borrowing heavily. And so you can see that in the cash flow statement as well. You can often see really what's going on with the business through looking at the statement of cash flows.
So I don't see any additional questions in the chat, but if anyone has a question and they'd like to raise their hand, I can unmute you. Look through.
If not, I can point out one other thing which is related to, oh, I see a raised hand. I can see that. Ava Ayers.
Hi, thank you. A real quick question. I was just, maybe it's not real quick, but do these principles apply to government accounting, government balance statements? And if so, is the terminology the same? Are the outlines that are the documents that you're outlining similar to what you would find when government does its budgeting?
Not necessarily. So a government budget won't necessarily follow the financial statements because typically the government's budget would be forward-looking and the financial statements are really backward looking. So no, and the government doesn't really prepare the sort of backward looking financial statements that private companies do. So it is a little bit different.
Thank you.
Good question. Anything else? So just very quickly, 1 minute left, the internal control over financial reporting. This was something new after the Enron crisis as well. This is part of the audit requirements that not only is the auditor responsible for making sure that the financial statements fairly reflect the financial condition of the company, they also have to review what the company's own internal controls are to be sure that things are being reported up correctly and that their own either accounting departments or other departments aren't misreporting numbers. And so that's something that the accounting firms are required to review, those internal controls that the company has. Well, thank you very much. This was a real pleasure. Mary, thank you for moderating.
Jennifer, I cannot thank you enough. This was so informative, and I know I'm walking away with a lot of knowledge. Thank you so much for sharing your time with us today and for being so willing to volunteer for this Women's Leadership Initiative. I really appreciate it.
Well, thank you.
Okay, everyone have a great day. I will be sending out the recording and a short survey either later this week or early next week.